All right, folks, welcome back to another REV Real Estate Live. My name is Dallin Schultz. I am one of the co-founders and president of REV Equity Group. We actively and passively invest in multifamily real estate, as well as some self-storage and RV storage assets as well. With that being said, these weekly webinars are focused exclusively on multifamily investing. Now, as I got started a few years back, I was unimpressed with the amount of resources and meetups and networks that were available for education on multifamily investing. So one of the things we've become very passionate about at REV is education and content, letting people know that there's other ways to experience passive income. There's other ways to invest in real estate. So every week we hit on a very important topic in the multifamily investing space and really try to simplify it. And in a way, I don't want to say dumb it down because there's nothing dumb about multifamily investing, but make it more easily understood. And there's not a lot of this in the mainstream education system. And very, very excited to have our guest on with us today, Mauricio Rauld. He also is very passionate about education and letting people know the powers of multifamily investing. And he'll get into a little bit about his background, his experience, and really the specialty that he brings to the space. So without further ado, I appreciate you all being on. As a reminder, if you have questions, please type them into the chat box. So that way we make sure that we can address them and that we don't overlook them. And then what we'll also do towards the end of this call is open it up to a live Q&A. So our topic today, what we're going to be focusing on is really the pros, cons, and differences between a fund and a syndication. They're very similar, a lot of overlap in a lot of different ways, and Mauricio will get more into that, but different investors have different preferences. And so we'll talk a little bit about that just to further your education and make it more make you more knowledgeable in knowing how to go about making some wise investment choices. So without further ado, we'll go ahead and turn the time over to Mauricio. Mauricio, appreciate you being on with us today.
No, I appreciate you having me on. Always love doing your events and appreciate everybody being on. And absolutely, please drop questions because I much prefer Q&A and making sure that we're delivering whatever value you're looking for as opposed to what we want to talk about. So, but I definitely will start off with a couple of comments on funds versus syndications. You know what? Probably the first thing I would start by saying, it's not really a pet peeve of mine, but just to get technical, a fund is a syndication, right? So all funds are syndications, not all syndications are funds. Because when you talk about doing a fund, what you're doing is raising capital into a vehicle, usually a limited liability company, an LLC, to then go do something. And we'll talk about the main differences, but you're still in the process of raising capital. You're still, pooling investor money. You're gathering the money. You're doing all the work. You're going to go find deals. But at the end of the day, you're still in the process of raising capital. And therefore we have to comply with all of our fund securities laws that we hopefully know about. And I'll touch on that, Dallin, if that's okay. I'll probably spend 2 minutes on it just so we don't leave anybody behind. But both with a fund and a syndication, and because syndications and funds are syndications, you're raising capital, which means you are in the business of issuing securities. And even though you may not think of it that way because you're buying real estate or something that really, it's not really in the stock market or anything like that, the definition of a security is really broad. As you've probably heard me say before, anytime you're raising money from passive investors where the returns are generated by your efforts, you're issuing securities. And when you think about it, if you've got an LLC, what you're really issuing and what you're giving investors are shares in a company, or in your case, they're going to be membership units in an LLC, but you're basically issuing shares in exchange for that $50,000 or $100,000 investment, which is why the SEC looks at you as selling securities, even though you're really just buying real estate. So that's kind of a common question at the beginning, is why is the Securities and Exchange Commission, the SEC, even involved in my business? But just like a regular syndication, let's maybe use that terminology, regular syndication versus a fund specific syndication, we have to either register our fund with the SEC, which we really don't want to do, or we want to find an exemption to registration or it's illegal. Those are our three options, right? And so we don't want to do anything illegal or anything non-compliant, and we usually don't want to register anything either, because registration, what that really means, it's code word for an IPO. Let's go in public, right? So you don't want to go out there when you're putting your fund together for 1, 5, 10, 20, $50 million. You're not going to go public and spend 7 figures on it and take 2 years to go to the market, right? So these are all private offerings. So we don't want to register. So we always look for exemptions, right? Again, whether it's a fund or a syndication, what exemption are we going to rely on? So we don't have to deal with an IPO and register it. We can just kind of do our own self-governing and documentation, and we don't have to register anywhere. And that's where you hear things like 506B and 506C, Reg A, crowdfunding. All these things are just simply exemptions that we rely on. And this is not, I'm not going to get into the details unless somebody has a question about it, but I know we've done other sessions on those, but same thing applies. So maybe that's our first similarity, is that number one, they're both syndications, you're both raising capital to do something. And so on both of them, we have to find an exemption to registration. Most of the times I will probably just comment that when people are doing a fund, I tend to see a little bit more 506C deals, meaning that they are allowed to advertise the fund, because usually a fund, they're raising more money. And usually when you're raising more money, you don't have enough money in your existing database or the people you already know and have, your friends and family and people you have relationships with. And so you typically on a fund end up trying to advertise, or, maybe you have a podcast or you have an audience that you want to, pitch this to, and you don't necessarily have a relationship with everyone. And so I tend to see more 506C deals, which allows you to advertise, but of course limits you to accredited investors only, $1 million in net worth or a couple $100,000 in income. And you have to verify that. That's probably one of the few things. But going back to sort of the basic, what's the word I'm looking for? Descriptions of them. On a regular syndication, what we're doing is simply we identify a property first. We're doing multifamily. So on a regular syndication, as you guys know, we identify the property. We typically get into contract first on the property, and then then it's the fire drill, right? Now you've got to close in 60 or 90 days, or your due diligence starts, and you've got a time bomb or a clock that's ticking, and you've got to go out there and go raise $1 million, $2 million, $5 million, whatever you need to raise for that particular property. And that can be fairly stressful, especially if you're a first-time syndicator. Yes, you've got extensions. Hopefully you have extensions built into your contract, but it's not uncommon, which is why you want to have extensions in there. It's not uncommon, especially, I don't know about these days, but certainly, a year ago, and especially during COVID, it's not uncommon for deals to get extended or not close on whatever date you thought of. No fault of either the buyer or the seller. It's not like the seller was dragging their feet or the buyer couldn't do it. It's literally the lenders just, didn't get around to it, or like whatever. And so sometimes you can't meet your deadline and it's no fault of either party. So you always want to have extensions. But even with extensions, you still have that pressure of having to raise a bunch of money. And if you've never done it before, or you don't have an audience, that gets stressful. So that's what a regular syndication is. You identify the property first, you buy the property, and then you raise the money for it. With a fund, it's reverse. With a fund, you raise the money first into your fund, and then you go out looking for property, or usually properties, right? The whole main point of a fund is to do multiple properties. And so that's the big difference. And what's nice about that, and maybe this is the first pro of doing a fund. And by the way, when I say fund, I'm talking about the exact same structure. I'm talking about an LLC. Right? When we talk about a fund, you're still just creating an LLC, just like you were creating in a regular syndication. We're just calling it a fund because the money is going to go into that LLC, into my bank account first, and then I'm going to go look for property, right? And so the nice thing about that, or the pro surrounding that, is that I don't have to stress about raising the money because the money's already in my bank account, right? And it gives you some leverage, right? I mean, if you can go, you're competing with all these other buyers, and you go in there and you say, look, I'd like to make my offer. Maybe you get to best and final. And you're like, look, I don't need to raise the money. I mean, these other guys over here, they've all got to raise the equity, and there's some uncertainty over there that maybe they can't raise the money, or they get delayed and all that stuff. With me, I've got the money in the bank. Here's my bank account. I got $3 million, $5 million, whatever the number is. I don't have to raise the money. All I've got to do is my due diligence and make sure that I'm comfortable with it. And once it's go or no go, you're almost guaranteed, or you are guaranteed, if I'm going forward, that I'm going to close. You don't have to worry about me raising the money. So that gives you a huge advantage. I've had other syndicators that actually, it's not with multifamily, but single families, for example, they might go buy a portfolio of single family homes for like $1 million or $2 million, and they'll buy them cash. right? Because they've got the $2 million in the bank account already. And so obviously you can imagine the kind of discounts and if nothing else, advantages of having a cash, which then you can later either refinance out of it or something. But it gives you a lot of power having the money in the bank. It gives you a lot more negotiating power with the seller. But more importantly, it gives you the peace of mind that you don't have to go scramble. You have to go scramble and raise the money. So that's kind of the big benefit of it. The big con or negative of it is that it's harder to do. I mean, let's be honest. I mean, if you're a first-time syndicator, you're probably not going to go do a fund unless you're some, you've got a huge podcast. And I do have some clients who are like YouTube influencers and they've got, 300,000, 500,000 followers. So even if they've never done a fund before, again, that's just goes towards the importance of having an audience to launch your product to or your syndication to. But typically when you're a first-time syndicator, the first couple of times you've got friends and family and people, it's very difficult to go raise a fund because the investor who's giving you money doesn't know what you're buying, right? They're literally betting on you. They're like, hey, I'm going to give you my 100 grand and man, I'm going to trust you individually that you know what you're doing and you're going to go find the right properties for us. As opposed to a specific, what I call a project specific raise. As the investors, you guys know, I can look at your business plan. I can look at the market. I can look at all the assumptions that you've made. Not all your underwriting, but I can look at your assumptions and I can say, hey, look, I don't like the marketplace. Maybe I don't like the submarket. I don't like the class. I don't like this is a C class and it's really crappy. Or maybe you're like, hey, look, you're telling me you're going to raise rents, by 30%. And I think you're smoking crack and there's no way you're going to raise that much rents in your business plan, but I think you might be able to raise 5%. So I'm going to readjust my underwriting. Like I can challenge your assumptions and I know what your assumptions are. You don't have that in a fund. In the fund, what you're basically telling your investors is, hey, I'm going to go raise a bunch of money and here are the parameters that I'm going to use to go find something. So for example, I'm going to buy real estate, right? You're not going to go use that money to go buy crypto or a marijuana processing plant, right? You're going to go buy real estate. You're going to buy real estate, presumably in the United States, right? You're not going to go buy something in Portugal or, Belize or something, right? You're going to be doing it with multifamily, right? As opposed to mobile home parks or self-storage or something else. Maybe you even get further down into maybe a particular region. Hey, we're in the Dallas, Oklahoma, Florida. Like maybe you even go to more submarket. You can go as broad or as narrow as possible. Even a multifamily, are you going to be buying fourplexes or are you going to be buying 50-unit apartment buildings, right? And sort of the details, but it's just the parameters, right? And from your perspective and from a legal perspective, we like to describe those as broad as possible, right? I mean, in my perfect world, I'll give you a perfect example. Dallin, you mentioned in the intro that we do work for Brandon Turner, Bigger Pockets, and he does mobile home parks. And because of his stature in the industry and so many followers, having one of the biggest podcasts out there, his fund literally says, we are raising money to go buy mobile home parks in the United States. Super broad, great for me because it's like I don't have to worry about giving more details that end up being wrong. And it's like how much broader can you get? Maybe I guess he could have opened it up to the world or something, but he can get away with that because who he is. But I would say that most people can't get away with that. So you've got to get more granular. But how you want to try and avoid to get as much granular as possible, but you want to be granular enough that your investors feel comfortable that hey, I'm going to give you 100 grand, and I kind of have an idea of what you're going to buy. So typically we do say, hey, it's multifamily. We'll usually describe the class as an A, B, C class. We'll describe the size, right? Are we looking at, again, 50 units, 100 units, 200 units, 18 units, like something like that. And then we'll also, describe the condition that the property is in. Are we looking for like stabilized cash flowing assets that we buy them and they're cash flowing 10% from day one? Or are we going to go in and really heavy value add and like we may not even make any money the first couple of years because we've got to go, we've got to put a lot of heavy value into it. So that's what I call either parameters or fund criteria, and that really is the main difference. Like if you look at sort of offering documents from that perspective, they look very, very similar. The main difference is going to be in that business plan, right? Because your business plan in a fund is very like literally Brandon's is a one-liner. I mean, you've got the other stuff that's still in there, right? Like description, who are you? Who's your team? Why mobile home parks? In this case, why multifamily? I mean, you go into other details, but there's no pretty pictures of the property, right? Because you don't have any properties. There's no market analysis, unless you're picking a specific market, which you might be. I mean, you may be like, hey, I'm going to go look for multifamily in the Dallas-Fort Worth area. And so you would have a section on that, but it's very broad and you're just giving those parameters. And even with returns, you're not really giving them projected ROI, because again, we don't know what the cash flow is of whatever property you're going to buy, or cap rates or anything like that. So we usually give what we call targets. It's like, hey, look, we're going to try and buy something that's going to kick off X to Y% cash on cash, and looking for an eventual IRR, a targeted IRR of whatever, 10 to 15, 15 to 20, whatever you want to put in. But it's not very deal. But that's the main difference is going to be in that business plan, because you're not going to be describing the thing. And again, the main difference is you've got to have people who would invest in you. You're betting on the jockey instead of the horse. I don't get to challenge my assumptions. So you better have complete confidence in that sponsor that they know what they're doing. And that usually comes with experience and track record, which is why first-time syndicators, it's harder for them to raise a fund. But again, if you're the host of a big podcast, or you've got a big YouTube channel, or you're just a well-known individual, you've got the greatest mustache in the industry, then maybe that's something that you can pull off your first time. But that's probably that's probably why, not probably, that's why you've got to have a little bit more experience. And that's why probably most people start, not only do they start small, but they start with friends and family, and then they maybe open it up to the public and under a 506C. And then eventually, once they've got 3 or 4 or 5 or 10 deals, and they've got a career and they've got a track record, then it's like, well, I'm tired of just raising money individually for each project. Let me just go put together a $50 million fund. And let's just, they trust me. I've got the track record. These investors have been with me for a long time. Just give me money and just trust me. Here's my track record. Just trust me and what I want to do. There are some challenges. And then after this, I do want to please put some questions in the chat so I can actually address. So it's not just me talking about stuff that I think is relevant. I want to make sure I'm hitting what your pain points are, or questions that you have. But there are some challenges. And so let's go through maybe some of the challenges that come up in a fund that don't typically come up in a project specific syndication. This is something that we experience all the time with first time fund managers, because these are things that you don't have to think about in a project specific that suddenly all of a sudden become an issue, right? So for example, one of the main issues becomes, do I take all the money now, or do I take soft commitments? Because what if I just I raise $5 million into my fund and I can't find a property, right? Because you don't have property. So it's just sitting in my bank account for 6 months. What do? Do I pay interest? Do I just take soft commitments until I find a property? Like, how do I deal with that? Because in a project specific, obviously, you know exactly how much you need to raise. You've got your use of funds, right? You know how much the property costs, all the value add, all your fees, all your blah, blah, blah. So I need to raise 2.35 million. With a fund, you haven't identified a property. So there's a couple of ways our clients typically deal with that. My favorite, well, let's start with the least favorite. One way is to just say, tough. Like, hey, you're not getting paid. If your money's with me for 6 months, we're not going to give you a return, obviously, until we deploy the capital. But it's okay, because we're going to, at the end of the day, when this fund is done in 10 years or whatever, the IRR, your returns are going to be great anyway. And it's not going to matter that for 6 months you didn't raise any money, right? Still, the returns are going to be great enough. That's one option. Another option that I've seen clients do is they kind of overraise to give them a little bit of an interest rate while they hold the money. So maybe before you deploy the capital, you're giving them, I've seen 2%, maybe 6%, 4%, whatever you think is reasonable. Maybe today a little bit more since interest rates and inflation have gone up. But basically, you'd have to overraise. So let's say, keep it simple. You want to raise $1 million, but you want to give somebody a 6% interest rate for the first year. Then you're going to have to raise $106,000, right? So that you can overraise and use that capital to give them that holding cost. Now, all of that has to be disclosed, obviously. Some investors aren't thrilled about the idea of just getting paid back with their own capital, but it's a legitimate way of doing it. A lot of people do it, because even though you're giving them back their own money, you still owe them $106,000, not $100,000, which is what ultimately is going to get deployed. But my favorite way of doing it, and what I typically recommend, is a form of a deposit. You don't want to do soft commitments, because if you need $5 million and you get commitments for $5 million, and then 2 months later you find a property, and you're like, okay, guys, I found a property, bring your money in. And then people are like, oh, market shifted, or hey, I had an emergency, or whatever excuse they're going to come up with. There's a good chance you're not going to have 100% of that commitment. You may have half of it, or a third of it, or 75% of it, or whatever. And now you're scrambling because you thought you had the money, and now you got to go continue to raise. So what I found has been pretty that works is to take a deposit. So an investor that commits to $100,000, They sign all the documentation, just like, again, you're going to see the same, maybe I should have said at the beginning, you're going to see the same. There's a PPM, there's an operating agreement, there's a subscription agreement, there's an investor questionnaire, your business plan, all the same documents you're familiar with, your project specific, you're going to see in a fund. But if they invest or commit to 100,000, just take like 10% of it. I think 10% is the number that most, I've seen 1 or 2 plans have done 20, but it's just enough of a deposit, because if they fail to give you the cash call, hey, once you find the property, you're going to ask for the remaining 90%. If they, for whatever reason, don't want to give it to you or can't give it to you within that 5 days or a week or whatever time frame you've given them, they're going to forfeit that 10%. So that avoids the issue of like, hey, I committed to you 3 months ago, but now there's this other deal over here that I find really attractive. I'd much rather go over here. So sorry, I'm not going to give you my money. Well, there's already a 10% penalty baked into that. So it makes it, from a return perspective, it makes it very less attractive to go somewhere else. And you kind of limit it to really people who truly have emergencies that have popped up since they made the commitment. I mean, legally speaking, they've signed a contract. They sort of owe, quote unquote, owe the money. But, from a practical standpoint, it's not like you're going to go sue an investor who gave you, 10 grand and then you gave him a cash call for 90 and didn't come through. But that's probably one of the biggest things that we see on some of the challenges. The other challenge is, are you going to raise all the money up front, or is it going to take you 2 years to raise the money? Because that's also a factor that you got to think about, right? If you raise all the money up front, then no problem. Everybody's kind of in the same boat. But if it takes you 2 years to raise 25 million and the person that comes in at the end, well, there's already 4 properties in the portfolio. There's already 4 properties that have been cash flowing. And there's a lot different risk for the last investor that came into the fund than the first investor who gave you the first 100 grand. They didn't even know what was going on. And so, you've got to address those issues. Is everybody getting the same price? Probably not. How are you going to value the shares moving forward? So that's just something else you want to be aware of. The other thing is exits. Like some of these funds, again, is everybody coming in on day one, and then this fund is a 5-year fund or a 10-year fund or what have you. And then everybody just gets, once the fund is over, we just liquidate and everybody gets their money back. Or is there a mechanism in the fund where people are allowed to come in and out? Is there a withdrawal mechanism where maybe after 2 or 3 years, you're like, you know what, I want my 100 grand back. And there's a mechanism for me to get that money back. We got to discuss that, because, funds generally are longer and some people are just more hesitant to have money locked up for 10 years or 15 years. So they're going to look for some mechanism. And again, what I would recommend is not let people come in and out whenever they want, because then your bookkeeper will fire you probably, because then you're like, every day there's somebody coming in or out. So you want to have a window, what we call a withdrawal window, somewhere in the calendar. So maybe it's like, hey, if you want your money out, if you're eligible to get money out this year, you got to give me notice, between August 1st and August 31st or whatever, between this period, you give me notice. So it's just once a year you're dealing with ins and outs. And you may want to put caps on that too. Like we've done deals where, just imagine you've got a fund and like 80% of the people want their money back. That becomes an issue, right? And so you could limit that to, at any given time, 20% of the fund is the max that we're ever going to liquidate. Or maybe not. Maybe you come in and you commit for the entire 5-10 year thing. And if you don't like it, you don't like it, you can go invest somewhere else, right? At a minimum, I think I would have some kind of a lockup period in there. So if it's a 10-year fund, maybe you're locked in at least for the first 2 or 3 years, and then you're eligible to get out. And then if you don't get out that point, maybe you're locked in for another 2 or 3 years. It's so flexible, just like the project specific syndications. You can be as creative as you want to be. I would encourage people not to get too crazy and too complex, because that, freezes investors. But at the end of the day, as long as we're disclosing everything and it's clear, you can structure them as much, however you want, which is why funds tend to take a little bit longer than project specifics, not in the drafting of the documents, because that's pretty much the same timeline, but more as to the structuring. Again, in a project specific, we all have our structures. We buy the property and maybe there's a pref and then it's an 80-20, and that's the same structure pretty much all the time. But when you get to funds, you start having creative, a little bit more creative structures. And to be frank, our clients just don't understand, or really it's the first time they've come into this world, so they don't even realize the possibilities that are out there. So we spend a lot of time really consulting with the clients and coaching them as to different ways that you can structure things, since we've done so many of these, which is another interesting point. Like, pre-COVID, I don't think we were doing any. We may have done a couple of funds pre-COVID. And then when COVID hit, we were getting a lot of calls about vulture funds, right? Everybody thought the world was coming to an end during COVID, 50% economic vacancies, all that stuff. And so everybody's like, oh, I'm going to go raise $20 million and I'm going to pick up all of these, whatever. That obviously didn't happen. But for some reason, and it's probably because there's so much liquidity out there, so much cash floating around, and people don't know what to do with it, the funds have become a bigger and bigger and bigger percentage of our cases that we handle on a monthly basis, where we're doing, I wouldn't say more than 50%, but we're doing a significant, I mean, probably a third of our business now is funds, when, like I said, pre-COVID, if we'd done a couple of these things, it wasn't too much. In fact, that's really what prompted me. I've got I think it's called how to structure a fund, or how to do or maybe just to do a fund. And I did that during COVID on my YouTube channel. I got all those videos. It was one of them, how to do a fund. And I recorded that just because that's what was happening. Everybody was calling me, especially back in COVID, right? COVID, everything froze, as you guys remember, right? Lending didn't happen. So there was actually zero activity for about 6 or 7 weeks, but we were getting a lot of stuff. So anyway, I'll pause there, down, in case, I know we got a specific question. I don't want to keep going on random, but everybody's got a specific question. I'm happy to answer them.
There is a question here, and Rick, I might have you expand a little bit on it, just so we make sure we clearly understand what's being asked. So the question here from Rick Mauricio is, what allowances apply to fund syndications, and what legally can a new syndicator do to get the word out?
I'm sorry, say that again, because I was reading the one in the chat. So this is different. Sorry, say that one more time.
What allowances apply to fund and syndications, and what legally can a new syndicator do to get the word out?
From that perspective, it's no different than a project specific, right? So it all comes down to the exemption that you pick, right? The two most popular exemptions that we syndicators in general use are typically of what we call a 506B as in boy, and a 506C as in Charlie. And the two pivot points, and what dictates which way you're going to go, is number one, do you want to advertise your syndication or your fund? Because if you want to advertise it, then you've got to go 506C, because you can't advertise in a B. So if you're saying, how do I get the word out? I said, well, you can go on podcasts, and you can put it on social media, and you can go make presentations at events, and you can do whatever you want, but we're going to have to select the 506C exemption, which allows you to do that. But you are going to be limited to accrediteds only. So if you're trying to get your, Aunt Karen and Uncle Pete in there, that might be an issue. On the other pivot point is the non-accrediteds, right? If you want non-accredited in your deal, because again, you've got Aunt Karen in there, then you're going to have to go 506B, but you can't advertise, right? So it all just depends on what you're trying to do. And then we'd have to work within those timeframes. But if you're doing a 506B, for example, which is, the most common for first timers, then you're not going to be able to get the word out to new people. You're going to get the word out to people you already have on your list, that you already have those, substantive relationships already established, your friends, your family, and people already. And then you can start emailing those people that you have those relationships with and let them know, hey, I know that usually, I'd probably have my own way of doing it, but hey, I'm known for doing these project specifics, but hey, good news, I'm launching my first fund next week, and here are the details. But you would not be able to go on social media or on podcasts or really advertise or generally solicit that at all, unless you do a 506C and take the consequences of that, which is accredited investors only.
Excellent. And Mauricio,
thank you.
Step in here if I'm misleading people, but if you were to do a 506B, tapping into your existing network, if there is a referral that came in through your existing network, then you would still be in compliance.
Yeah, yes, I know there's some controversy about that. But yeah, the rule actually says that you cannot generally solicit or advertise. It doesn't actually say that you have to have a pre-existing substantive relationship. That's the most common way to do it. 99% of the time, that's the way you're going to prove that you didn't generally solicit it, is by having a pre-existing substantive relationship. But there are other ways, and that would be one of them. If you have an existing investor, for example, that says, hey, I'm in your deal, I love it, I want to invite my cousin Bobby over here, can I make an intro? Absolutely. If you have an investor like, hey, I'm tapped out, or actually I don't like multifamily because I'm into self-storage, but I know Johnny over here is interested in that, so do you mind if I make an intro? What you want to have is something in your file that shows or proves that you didn't reach out to them, right? So you want to have an email in your file. Remember, this is all about record keeping. So this is all about something going south 5 years from now, and the regulator breathing down your neck and saying, hey, this guy Bobby says he found you through a social media post, doesn't know who the hell you were. And you're like, no. Here's the email that I have from Bobby, who reached out, or whoever reached out to make an introduction to Bobby. And here's my proof that I did not generally solicit or advertise to that person. So yeah, referrals are one other way that you can show that you didn't genuinely solicit or advertise.
Excellent. And it looks like there's a couple more questions here. How would a syndication fund handle an investor's 1031? Say I wanted to sell my rental house, roll the money into a new fund. How would that look? I think this is an excellent question because this is something that we ourselves actually spend quite a bit of time educating investors on. So Mauricio, go ahead and share your thoughts on that.
Yeah, I'll give you my thoughts on that. I'm just going real quick here onto my, not to do a shameless plug, but we did a whole 1 hour, and I'll give you the bullet points because it's actually probably a 3-day seminar to be honest with you. But we did a 1031 on my syndicator live. I think it's episode 4 or 5. I'm just going to look through here so I can point you guys in the right direction. Or maybe I can just put in the show notes or something. But where is this 1031? I don't know. It's somewhere in there on the earlier episodes, probably between 1 and 10. So just like a regular syndication, you cannot 1031 from your relinquishing property into a fund or a project specific syndication in terms of being a limited partner, because you're going from direct title over here to shares in a company or units in an LLC. So it has to be a like kind exchange, right? You've got to relinquish direct title to the property, and then you've got to take direct title to the new property, right? And so the way you do that is through a tenant in common, right? So you have to, let's say, give you the example of, let's say that you're selling your property and that represents roughly 10% of the funds of the syndication that you're going into. Well, then you have to take 10%, it's not exactly, but about 10% of direct title to that new property. And then the syndication or the fund would own the other 90%. So now you have really two owners of that property, the syndication LLC, and then the 1031 investor. And then you tie that together with a tenants in common agreement, a TIC agreement that kind of outlines all the who's managing, who makes the decisions. So that's how you have to structure it. Now, there are, from a security standpoint, there's not much, to be honest with you, from a security standpoint, it's not a huge deal. There's obviously a couple of additional risks that we have to disclose. To be honest with you, the 1031 investor basically will have veto rights, right? Because even though you may draft in the contract that you have as the manager the full discretion to do whatever you want, realistically, if you want to sell the property, the title company and the seller's probably going to want that investor, that 10% owner, to sign off on the contract. If you want to refinance, all that kind of stuff, you're going to have to get their blessing. So it does pose some risk to the LP investors. And then, what if the 1031 blows up and you didn't do it right for whatever reason? And so there's some additional risk that the 1031 investor ends up suing the syndication and the manager and sues the whole world. So there's some additional risk. But honestly, from an SEC standpoint, it's not a huge deal. Where it's a huge deal is from the IRS's perspective, right? Because when you're doing that syndication model, taking money from a 1031 and doing it properly into a syndication, like we just described, there are 15, I believe is the number. There's 15 limitations. Well, that's what they are. There are 15 limitations or parameters that you have to fit into in order to pull that off. There's I almost feel like I'm dyslexic when it's a revenue procedure code. I want to say it's 2002-20 or 2002-22. One of those. I'm happy to find the link to it. But there's 15 things, and all 15 aren't necessarily relevant, but that's what we went through the whole hour before on that YouTube video. But the most important ones are this. You have to distribute, as the syndicator, you have to distribute the profits of the property proportionally, meaning if it's in my example of the 90-10, 90% of all the distributable cash has to go to the syndication LLC and 10% has to go to the 1031 investor. You cannot take a preferred return. Like if your structure is a 7% pref and an 80-20, I can't do a 7% pref and 80-20 on that 10%. I've got to distribute cash 90-10 first. And then the 1031 takes that 10% and puts it in the pocket or her pocket. And then that 90% that goes to the syndication LLC, that you can then split with your LP investors in there, however you want. If you want to have a pref and a 20% carried interest or a 30% carried interest, 70-30, 80-20, knock yourself out. But at the TIC level, you have to distribute monies proportionately. You are allowed to take what's called a reasonable asset management fee, right? So if you want to take a 2% of gross rents or effective gross rents, knock yourself out. But again, 90% of that has to be borne by the syndication LLC and 10% would have to be borne by the 1031 guy. And then you can take a reasonable acquisition fee. And that's just a conversation you have to have with your CPA to see what they consider to be reasonable. And again, that's adds to the risk, because if your CPA says, yeah, 2% is fine, and the IRS for some reason disallows that and blows the 1031, there's a little bit of exposure that your syndication can get sued. That's probably the main one, but there's no more than 35. But that's probably the big one. But I would definitely check out that video. We go through all 15 of them, and I focus on, I think there's 6. Honestly, I'm blanking on the top of my head of it. Maybe another good one, but that's the main one, because it really doesn't work a lot of times if that 1031 is coming in with a lot of money. Because let's just say they own 30% of the property. Well, that's 30% that you're not going to get really paid on in terms of carried interest. You're not getting paid on that. And so that's one of the limitations that you want to look at. But it's purely IRS. From a security standpoint, I can structure things however you want. As long as we disclose it, as you know, you're going to be good.
Excellent, Mauricio. Monica, if you're present with us, I might just have you ask your question out loud.
I think it may have been answered already in that last few words that he spoke. But basically what I was wondering is, like, if somebody brought money into the fund and they just wanted to take the percentage and let the money ride, is that allowable?
You can certainly structure it that way. I mean, it goes back to what did you disclose to everyone, right? Because you're going to have to come up with those rules. That's one of the challenges. You've got to come up with the rules, whatever those rules are. You can come up however you want to do it, but you've got to think of those ahead of time, because we want to put all that information in the PPM, so we're disclosing to the investors what's going on, and obviously in the operating agreement as well. So it depends on how you're structuring the fund. I think that has to do more maybe with withdrawals, where you would say, hey, look, after 3 years, you have the option of taking your money out, and this is what we're going to pay you, because you got to also figure out, that's another issue. Like, how do you calculate that stuff? And to me, it's just easier just to come up with a set return. Like, if you want to get your money out early, great. We'll give you your 100 grand back, plus we'll give you 10% or whatever you come up with. That's the easy way to calculate it. But then you have the right, you don't have to come out at that point, because it's a 10-year fund. So in year 3, you may have the option to just reinvest those, just keep it in there, or reinvest that money. So as long as it's disclosed and fit into the structure, you can absolutely do that.
Awesome. Thanks.
I'm glad you found the 1031 video. It's like, what episode was it? It was like 4 or 5 or 8, or I don't know. I remember what it was.
10.
10. Yeah, I did say between 1 and 10. So that's good. All right.
Yeah. So in the chat box, I included 2 links. One was to Mauricio's overall channel on YouTube. He puts out tons of excellent content around the securities world. And something that Mauricio's been getting into quite a bit lately also is tokenization of real estate. So a lot of good videos on that. So feel free to check them out there. And we're not closing right now. I'm just letting you know what I put into the chat box.
I'm really trying to grow that too. So if you're finding value in this or any of those, I really appreciate a subscribe or some likes on some of those videos to get that. It's still pretty small. I really just started it up again. What's really fun? I'll tell a quick story. It's really funny is that I started doing the YouTube channel pre-COVID, and I was really, I kind of, not hardcore, but I was putting out a lot of content in 2019, which I think is when, or maybe 18 is when I started the video. I did my flip chart Fridays that my people make fun of me of. And was at an event, at Rod's event. He calls me a dinosaur because I have a flip chart even at live presentations. But and then COVID hit, and you would think that with COVID, man, I got a head start. I'm already out there digitally doing, I'm not traveling and all that stuff. And I literally shut down. I went the complete opposite. Like I didn't put out a single video except for that how to start a fund video. I didn't put a single video out during the whole, like for 2 years. I did a lot of podcasts and webinars for other people, kind of like this, but I didn't put any of my own content out. And then I finally got going again, probably when I launched, probably last November or October. So it's been maybe a year now that I started putting out, and I'm trying to put about 2 or 3 videos now a week. And I'm experimenting with these shorts too. So I'm trying to put out a short every day. So, but it's been fun. It's been a lot of fun.
Excellent. Yeah, Mauricio does an excellent job with this team in educating them, providing those resources to other syndicators and operators. So the first link was a link to his channel. The second link was specific to his video on doing the 1031. So really good content there. Mauricio, one thing I wanted to bring up and have you touch on a little bit. So as we've looked into funds, and you and I have actually had this conversation a while ago, it's easy to cross over into the investment advisement world when you're operating via a fund versus maybe a property specific syndication. So can you speak to a little bit about ways to maybe some additional exemptions or ways to navigate that while still remaining compliant?
Yeah, another shameless plug is we did this on Tuesday and I just released it about an hour ago, but it's a little bit different there. So when you're doing a fund, which is what we talked about today, when you're raising money into your LLC and then you go out and look for properties, that you invest in, then that's just a regular fund. And in that case, you don't have to worry about what I'm about to talk about, right? What I'm about to talk about only applies if you are doing what we call fund of funds, meaning you're doing the same thing we just talked about, which is you're raising money into your fund, but instead of going out and buying properties like we just talked about for the last 45 minutes, you actually go and invest in other people's deals, other people's syndications, right? So let's say, you know, Dallin's got a syndication. I go raise a bunch of money and I look at his deal and say, this is a great deal. Let me put in $1 million as an LP in his deal. The subtle difference there is that on a regular fund, you're raising money, right, pursuant to whatever exemption, and then you're investing in real estate. No problem, no additional issues. But when you're doing a fund of funds, you're raising money into your deal, and then you're buying securities because you're basically buying shares in somebody else's company. You're buying limited partnership units, again, to be technical, membership units in somebody else's LLC. So it's very similar as to buying Apple stock or Microsoft stock. So you are now raising money, and the way the SEC looks at it is you're advising your own fund as to the purchase of a security now, as opposed to purchases of real estate. When you buy real estate, you don't need a license. When you buy securities, you might. And that's when this whole new world pops up of this funded funds. And yes, as you mentioned, there's typically 4 things, really 3 additional things that we talk about when we do a fund of funds. Again, you're raising money. Let's say you raise $10 million and then you go look at this deal. It's great. I'm going to put $10 million into Mauricio's deal, $10 million here, or not $10 million here and there. So the first one is, again, same exemption and same rules that we just talked about. You're selling securities. You got to find a 506B, 506C, Reg A, whatever you want to do. Same rules apply. Again, with the fund of funds, I tend to see much more 506Cs and maybe even Reg As at that point, but it's the same rules. You got to find the exemptions, Reg D, Reg A. But then there are some...
Real quick on that, could you do a 506C into a 506B?
Only if the 506B, you can do a 506C into a 506B. You can't do a 506B into a 506C. You can't do a 506B into a 506C unless the 506B that you're doing limits it to accrediteds only, which is done. Everybody assumes that a 506B means you have to have non-accrediteds, and that's not true. 506B is just the exemption, and there are plenty. In fact, not our world, but if you look at the securities world in general, when you include the JP Morgans and, you know, the Merrill Lynches, and BlackRock, for just a little divert a little bit, BlackRock, I used to use BlackRock as my example, or Blackstone, I can't remember which one it was, but BlackRock or Blackstone, they had like it was a $2.6 billion real estate fund. That was back then the largest. I kept citing that one. And that's a 506B. But it's accrediteds only. I mean, they use broker dealers. I mean, 2.6 billion. You should check out what the broker dealer fees end up being. But if you look at their Form Ds and everything, it's a 506B because all of the broker dealers have pre-existing relationships with their investors. So a lot of the big guys, they use 506B because they have broker dealer relationships, but they don't have any non-accredited. They don't deal with a non-accredited. So just because you did a 506B doesn't mean you have a non-accredited. So if I do a 506B, and I only accept accredited investors, which, to be fair, in our world, you know, if you're going to take a credit, although look, I'll knock Kenny McElroy on this a little bit. And Kenny, if you're watching, I apologize. He does accredited. He does a 506B and takes accrediteds only. So there's a good example, right? Ken McElroy, one of the probably a larger, you know, smaller, not small, he's got like $1 billion, but he does 506Bs and he takes accrediteds only. So if he does a fund of funds, he could invest in 506Cs because all of his investors in his funds are accrediteds only. But so that's kind of a but a 506C. If the 506B has not accredited investors, it wouldn't be eligible for the 506Cs. That was convoluted or not. But when you're doing the securities thing, so the other thing you have to realize or just recognize, you're not going to know the answer, but at least something needs to trigger in your brain. It's like, oh my God, I should reach out to my securities attorney. Because you're advising your fund, not as to the purchase of real estate, but to the purchase of securities, that makes you an investment advisor. That's how the SEC looks at it. You are an investment advisor advising your funds as to the purchase of securities. So we have to figure out whether there's some registration process there or if there's an exemption, right? And that, because just because you're an investment advisor isn't the end of the world. The question is, do you need to register as one, right? The registration is kind of not the end of the world, but it's a pain. So you want to find an exemption. That ends up being usually a state-by-state issue. So you have to look at the particular state where you live in. So I live in California. I've got a separate set of stuff. The Dallin who lives in Phoenix or in Arizona, I think you're still there, or maybe you've moved. So it's just a state-by-state issue. And most states have some exemption, so you don't have to register as an investment advisor, which is the good news. The bad news is, depending on the state, they vary from not a big deal to a big deal. And when I say not a big deal, states like Pennsylvania, states like North Carolina, as long as you're not doing more than 5 or 10 or 15 of these funds, they don't care. Then you go to the other extreme, like Massachusetts, where they say, yeah, you don't have to register, but you've got to limit your investors to $2 million in net worth, which kind of kills it. And then Washington and some other states are like, oh, you've got to have $5 million in investable assets to be an investor in your deal. So that really kills it. So in those states, you probably need to register, but most states have some limitations. Probably the most common one is they often limit you to accrediteds only. That's probably the most common, like Texas, California. Texas is not a big deal, except you just got to make sure that your investors are all accredited, and you file some little form with the state of Texas, and boom, you don't have to register as an investment advisor. But that's the other thing. Again, just think of that as another compliance world. So we've got the Reg D and the SEC stuff that we usually know about. You've got the investment advisory issues over here that we got to make sure we check that box. You're also a passive investment company, right? You're just holding money, and you're basically an LP in all these other sub funds. That makes you a holding company. And so you want to make sure you're not, qualify as one. There's something called the Investment Companies Act of 1940, which is another thing you don't want to be a part of. So you don't want to have to register under as an investment company. So there's exemptions to that. And the most common one is just making sure you have less than 100 investors. That's where that 100 number comes from. So generally speaking, if you have less than 100 investors in your deal, then you don't have to register as the Investment Companies Act. The reason I say generally is because the rules are pretty complicated as to what counts as an investor. So you may think that, oh, I've got 100 investors, I'm good, but it turns out you have 113 the way they count it. So if you're anywhere close to that number, I would also check with your SEC. And then the last one, which I think is probably the biggest one, is just you always have to worry about broker dealer issues. You want to make sure that when you're raising money for somebody else's deal, it doesn't look like you're acting just raising money for that person, because you need a license to do that, right? You need a broker dealer license to raise money for somebody else. And so there are certain safeguards that you have to put in there to make sure that what you're getting compensated for is not raising money and giving it to the operator, but it's adding value to your investors and doing due diligence on the sponsors, doing due diligence on the property, negotiating better terms on behalf of your fund because you're coming in with a large amount. So if I'm going to give you $1 million and you're looking for 3, I don't want the regular common stock distributions that you're giving to everybody else. I want some better deals, and those better deals benefit my investors, and all that stuff is what you're really getting compensated for. You're not really getting compensated for just raising a bunch of money and giving it to an operator.
Excellent stuff. Well, we got a few minutes left. Any additional questions that anyone has for Mauricio in regards to funds or syndications? We're looking for some additional clarification.
I just want to say thanks for always putting so much value out there.
Well, I appreciate it, Trevor. Really good to see you. I see you, I think, all over the place as well. So thanks for always being supportive. Yeah, what I know, an interesting question, again, something I don't really think about when you're doing, especially maybe it's more of a fund of funds. I didn't mean to hijack the fund of funds conversation, but K1s is always interesting, right? So from a K1 perspective, when you're doing a fund, for example, just a regular fund, you're obviously going to be giving your K. That's no different than a project specific. Your fund has a bunch of investors. You're going to do tax returns for your fund, and then you're going to issue however many K1s you need to issue, depending on how many investors you have. When you're doing a fund of funds, you've got to recognize that your revenue that goes into your fund is the distribution that the underlying fund gives you, right? You're not getting percentage of the rent. I mean, you are indirectly, but it's not like you're just getting all the rents and you got to pay your debt and then you get your NOI. None of that, right? You're just basically a 10% owner of the underlying syndication, and they're going to issue you one K1 that's going to show how much money you made this year. And you're going to aggregate those. Let's say you're in 3 or 4 different deals. You're going to get 4 different K1s into your fund. But then again, your fund's then going to turn around and issue one specific K1 to each and every one of your limited partners in your fund.
So a little bit more steps on the accounting side, and so you'll absolutely, if you have the right CPA in place that has experience with this, then they could definitely help you navigate that.
I talk too much. Sometimes I answer all the questions before they get asked.
All right, looks like there's another question here. if I want to take 50,000 from a self-directed IRA, how would that work with a syndication fund? Anything special? Now, with in regards to self-directed IRA, you just select that option when you're working with some operators. There will be an election you can make that's saying, hey, I'm going to invest personally, I'm going to invest from an IRA. So you select that option and you just invest right through that IRA. So nothing special or different in regards to that.
The only challenge with the IRA sometimes is just timing, right? So if you're the sponsor, just recognize that it does take a little bit more time, especially if somebody's trying to, I don't know if people still use it. There was an IRS ruling that came out that put a little doubt into what we call these checkbook IRA. A lot of people are setting up these LLCs through their IRAs and investing through those vehicles. Those used to take a lot, because it's like by the time you've got to go to a self-direct, like for example, let me give you, it actually doesn't even matter if it's a checkbook IRA now that I think about it, but let's say you've got your IRA at Fidelity, right? You've got to transfer it to a self-directed IRA in order to make an investment in a syndication. So maybe that's a good distinction there. So if you had a 401k of a job and then it just rolled over into an IRA, converted, and you're with like Wells Fargo or Fidelity or one of these guys, they're not going to allow you to go invest in the syndication. You're going to have to go find a custodian that will allow that, what's called a self-directed custodian. And that transfer process just takes time. I've seen it take as many as 3 weeks. And so you've got to basically open an account on a new thing, which doesn't take that long. But then you've got to ask or make the request for the old, like at Wells Fargo, to go transfer your 500 grand or whatever from that account over to this new account. And Wells Fargo has very little incentive to hurry up. I mean, they make their money on the float. So every day they keep that 500 grand is money that they're making. And so it does take a little bit of prying out of Wells Fargo to get it into your self-directed custodian. And once it's in there, then you have the authority to direct them, hey, here's the investment I want to make. I want to put 50 grand into this LLC and blah, blah, blah. And then that still has a couple of days because it's got to go through their compliance department to make sure that you're not investing that violates the IRA rules. There's no self-dealings and all that, all that stuff. So so it just takes a little bit longer. But yeah, IRAs is a great, especially with the crappy returns they usually get wherever they are. It's a very appealing thing.
And we'll be doing a webinar specifically on investing through a self-directed IRA. So we'll be doing another webinar on that with more information. One note I'll make on that is, and Mauricio just mentioned this a second ago, with a self-directed IRA, just because it's self-directed, you can't invest in your own deals. The way they look at it is, if you look at the lineage, you can't invest up or down in your family tree. You got to invest horizontally. So so you can't invest with your father, your grandfather, your son. So self-directed IRAs are a very powerful tool that active operators still use to invest in other operators' deals. They can't invest into their own deals, but they're able to come in as LPs into other people's deals. And I know the majority of the operators I know are growing both actively and passively. Because at the end of the day, we all want our time back. And that can only be accomplished through actively, passively investing in real estate, right? So a lot of us are actively involved because we're very passionate about it. We enjoy it, and we do a pretty dang good job at it. But at the end of the day, we still want to build up that passive portfolio as well. And because that's really what's ultimately going to buy back the time that we want to spend with family, friends, vacation, whatever's most important to us. So we'll get a little bit more deeper into the IRAs on an upcoming webinar, but very powerful investing vehicle.
Yeah, 100%.
Excellent. Well, I think that's all we got for today. And if you had some questions, you should have put them in the chat box, or should have asked them sooner. So, Mauricio, thank you so much for taking time out of your day today. It's always a pleasure speaking to you and having you. You always bring a tremendous amount of value to our group and to our audiences. So appreciate it. Thank you so much. Everyone else that's been on, thank you for spending this hour with us this morning, or afternoon, I guess, depending on where you're tuning in from. But these webinars are hosted every Thursday morning from 10 to 11 Arizona time. So Mountain Standard Time. It's all content, all education. There will never be any solicitation of any deals on these calls. It's specifically there for you to make wiser choices moving forward.
Be careful though, because Saturday there's a time change, and you weirdos in Arizona don't change the time. So next week it'll be a little bit different time waste. So don't miss it next week.
Yeah, just Mountain Standard Time. So yeah, appreciate that. Shout out, Mauricio. So all right, guys, thanks so much for coming out, and we'll be in touch. Thanks a lot, Mauricio.
Thanks, appreciate it. Thank you, guys.
Take care.